I'd like to talk today about what might be the most boring industry in the world, but also the most important. Mainstream finance will never talk about this industry because it's never going to catch anybody's attention. It's never going to sell advertising. On the surface, it's about as dull as finance gets. But this industry is foundational to what we call capitalism today. It sits quietly underneath all of the investments and the macroeconomic themes that we've been talking about. What's more, there's a secret at the heart of this boring industry. It's a secret that's been hidden in plain sight for centuries now. Something that predates Wall Street and all the modern financial wizardry that exists today. In fact, it goes all the way back to my own ancestors, the ancient Phoenicians, who were pioneering trade routes throughout the Mediterranean world back in biblical times. But this secret is just as relevant for us today. And if we understand it, we'll start to understand the true secret to wealth. Indeed, this is the secret that lies at the heart of Warren Buffett's fame and fortune. And I would argue that it's the only reason Buffett became wealthy. And here's the best part. We can take this secret and its lessons and implement them directly ourselves to create true financial security. There's nothing magical about it. It's right there, and it's available to all of us. So let's get into it. Hello and welcome back to the Phoenician League podcast. I'm your host, Joe Withrow. Now, if you've been with me the last month or so, we've spent quite a lot of time out on the fringe of finance. We've talked about Alexander Hamilton's American system and what the U.S. Treasury is up to. We've talked about Kevin Warsh and his regime change at the Federal Reserve. We've talked about how financialization hollowed out the American economy. And we even talked about Jesus of Nazareth and how his view on the kingdom of God applies to money and investing today. So I think we've built up a pretty good track record already of talking about things that you probably won't hear very many other places. And I would hate to ruin that track record today, so we're going to keep it going. So last month, we talked about how Kevin Warsh has called the Fed's balance sheet bloated, and he's signaled that he intends to shrink it. That's something that we need to watch closely. Right now, the Fed holds roughly $6.7 trillion worth of assets on its balance sheet. Most of that is U.S. Treasury bonds with some mortgage-backed securities mixed in. When the Fed buys trillions in treasuries like this, it functions as a permanent, reliable buyer of government debt. And it keeps the whole financial system flush with the liquidity. It's the source of endless liquidity that has really the economy has come to lean on for nearly 2 decades now. So if Warsh follows through and steps back from that role, where does the liquidity to keep the real economy running come from? The consensus answer, if anybody even bothers to ask the question, would be probably, it'll be the banks, right? But the banks are constrained. Post-2008 capital rules make it expensive for American banks to hold assets on their balance sheet. So in the current regulatory environment, bank credit is just not the patient, permanent capital that a generational rebuild requires. And that's what we're seeing in America today, a generational rebuild. And we'll talk more about that in just a few minutes. But there's another institution that's perfectly positioned to fill this gap. And it happens to be the institution that was central to the rise of commerce in the very first place. That institution is insurance. Boring old insurance. To understand why insurance is so critical to the economy, we have to go all the way back to the beginning. Not the beginning of insurance, the beginning of trade, and the beginning of commerce. The thing that we call capitalism today, the system that enables people to accumulate capital and then deploy it across distances to finance productive efforts, that could not have existed without a mechanism to survive catastrophic loss. That was never more obvious than in the ancient world. So if we think about an ancient merchant, loading up a ship with all of his wares, all of his goods, and that ship, it's going to go on a voyage across the sea to sell those goods in a foreign land. Well, if that ship makes it home, the merchant's probably going to be a wealthy man. But if the ship sinks, he's ruined, right? He's lost all his goods. Under those terms, no rational person would accumulate capital only to risk it all on just this one single voyage, because the downside risk would be total. So in that world, trade tended to stay small and local. And indeed, so many of those ancient civilizations, they just focused on war and conquest rather than production and trade because that was considered to be a better bet. That's what made the Phoenicians different. And the innovation that broke through that ceiling was risk sharing, right? Risk sharing. Groups of merchants and ship owners learned to pool their exposure so that one lost cargo didn't destroy any single person. Instead, the loss would get absorbed and then spread thin across the entire group. And we have records of these arrangements going back thousands of years, back to the time of the Phoenicians. So there's something called a bottomry loan that's well documented from that era. And that's where a lender would advance money against a ship. And then if the ship was lost at sea, the lender would forgive the debt. And so the lender ate the loss. And so in that way, the merchant could take the voyage, really take on the voyage without betting his entire existence on it. And there was also a principle called general average. And the idea was that if cargo had to be thrown overboard to save a ship in a storm, all the merchants in that pool would share the loss. It wouldn't just be the ones whose goods happened to get thrown overboard. Everybody would share in the loss. And so that was really the birth of insurance. Risk started to get pooled and then shared so as to mitigate the risk of catastrophic loss. So insurance wasn't just some product, that got bolted onto capitalism after the fact. No, risk pooling was one of the preconditions that made capital formation possible in the first place. And so it's what let capital keep, kind of circulating and compounding instead of getting really periodically wiped out and destroyed by catastrophic events. So I know a lot is made of banking's role in the development of commerce, but I would argue that insurance is at least as equally important and maybe more so. You just can't have large-scale commerce without insurance. So we are talking about one of the oldest ideas in commerce here, but it's still very relevant to us today. And there's a secret buried within it. We can start to see the secret if we analyze a well-run modern insurance company. There's magic in there, but I don't think one investor in 100 really understands it. Because if they did, they would probably be doing things a lot differently. So we all know how insurance works, right? You buy a policy to protect yourself against events that would otherwise be catastrophic. So, your home insurance pays you if your house burns down. Car insurance pays you if you're in an accident. Life insurance pays your beneficiary when you pass away. With life insurance, that catastrophic event is pretty much guaranteed. As much as the longevity nerds in Silicon Valley are trying, I don't think anybody's going to be cheating death anytime soon. But when we talk about things like house fires and car wrecks, those events may not occur for years, or they may not occur at all. That's called property and casualty, or P&C insurance. And those are just the most obvious examples. Companies buy insurance for all kinds of other things. Maybe it's a hurricane, or maybe it's a factory burning down, or a contractor walking off a job, and leaving it half finished. Or maybe it's a lawsuit landing on the company's doorstep. Any number of things that may or may not happen can be insured against, right? And if these things do happen, they're probably not going to happen for years. So here's the thing. The customer pays the insurance premiums regardless, right? The insurance company gets paid every month or every year, whether the bad thing ever happens or not. So the insurance company collects all the money up front, but it doesn't have to do anything at all for the customers unless the low probability catastrophic event actually happens. So what does the insurance company do with the money it makes in the meantime? Well, it invests it, right? And that gap between the premiums collected today and the claims that might have to get paid one day in the future, that gap in there, that's called the float. And that is the entire secret to Warren Buffett's success. It's not at all an exaggeration to say that Buffett owes his whole fortune and his whole legacy to the secret of the float, insurance float. And he knows that. He's said so explicitly. Years ago, he said, and I'm going to try to get this quote right. He said, we get to enjoy the use of free money, and better yet, we get paid for holding it. That's the whole game, getting paid to hold money. And here's something I don't think people realize. Buffett, on the whole, he was actually really a fairly mediocre investor. Now, he did make a handful of great investments very early in his career. American Express, Coca-Cola, definitely Geico, and See's Candies was another good one. Those were great investments. But for the last 20 years or so, Buffett's track record leaves a whole lot to be desired. His company, Berkshire Hathaway, it has failed to even beat the S&P 500 in that time. Buffett has underperformed the market. And he even got caught up in the peak oil grift and lost billions on it a number of years back. And yet Buffett is still one of the wealthiest men on earth. He's still considered to be a great investor. And every year, throngs of investors still make the pilgrimage to Omaha to hear him speak, or at least they did until he retired here recently. But that tells you how powerful this business model is. A guy who has been a mediocre investor for decades now remains one of the wealthiest people alive because he learned the secret of the insurance flip, and he used it. So that's the magic behind Buffett's fortune. It's not the stock picking that he did. It was the machine that was just constantly running underneath him. So simply put, insurance companies benefit from a negative cost of capital. And there is no equivalent to this anywhere else in finance. That is the closest thing to a magic trick that exists in the modern economy. And it's hiding in the most unglamorous industry on earth. Okay, so now let's connect this back to our big question. Where does the liquidity come from to drive economic growth forward if the Fed steps back and starts paring down its balance sheet? Well, America's best insurance companies are well positioned to fill that gap. And that's because the best insurance companies are sitting on a private pool of permanent, patient capital that's always ready to be deployed. And that's because they constantly have insurance premiums coming in, but they don't have matching expenses in the present. They've got the float that they can invest. And so when I say permanent pool of capital, I'm mostly comparing it to the banking model. Banks can only make loans on top of their deposits, but anyone can go to the bank tomorrow and withdraw all their money if they want to, right? So bank deposits, they can disappear at a moment's notice. And that's not the case with insurance. Premiums are non-refundable, right? Once you pay for an insurance policy, that money is the insurance companies to keep, and they're going to do with it whatever they will. And so where do insurance companies actually put that money? The single largest chunk of it goes to investment grade corporate debt, corporate bonds. In other words, they lend money to financially strong corporations which finance productive activity. And they're doing this at exactly the moment that the banks cannot do so, at least not at scale. And it's not just corporate bonds. Insurance companies also invest heavily in private placements. They invest in commercial mortgages and in infrastructure-backed debt. That's a big one. So in a very real way, the insurance industry is the private, non-bank funding source for corporate America's activity. So the insurance industry, in a sense, is a shadow banking system that's been operating in plain sight for centuries now. But unlike the shadow banking system that blew up the financial system in 2008, this one is conservative. It's analytically driven. It's matched to long-dated liabilities in the sense that insurance companies do actuarial analysis. And they've got it down to a science, how much or what their expenses, what their claims will be in a given year based on the probability numbers. It's really, I don't understand it, but if you talk to an actuarial guy, it's amazing. We've got one in the Phoenician League, and I'm blown away by the craft. But anyway, the point is, insurance companies, they have money that's not going to rely on overnight funding. It's not money that can vanish overnight. It's not money that's going to vanish in a crisis. And here's what I think is the most important piece. The capital held by insurance companies, it represents real savings, right? It's money that was actually set aside against future obligations. It's not credit that was conjured into existence out of thin air within the banking system. Okay? So that's the key distinction. It's real capital in the truest sense of the word. So I'm confident in saying insurance is central to the story of America's great reorganization, which is the story that we've been tracking at the Phoenician League really for years now. Guys, the reality is that America outsourced its productive capacity to Asia. The country offshored its factories, its supply chains, all its semiconductor manufacturing, or at least most of it, sent all that stuff overseas. In exchange, we got cheaper goods. And we got fatter corporate margins, which helped drive the stock market higher. But what America kept was the financial engineering layer that ran on top. The banking, the trading, the financing games, the paper wealth. In the process, though, we gave up our physical capacity to actually make things. That era is now reversing. And it's reversing for reasons that go well beyond politics. And the big driver appears to be the AI race, artificial intelligence race, which the world's governments and largest tech companies, they seem to think this is existential, right? They seem to think that it's absolutely critical to have the most advanced AI. But training and running AI takes an enormous amount of physical infrastructure. Massive data centers, advanced computing hardware, next generation cooling, staggering amount of electricity has to go into these things, right? And that's electricity that our neglected power grid just isn't built to handle to the degree that they want to expand this thing out. So there's a genuine large-scale effort underway to reindustrialize and rebuild the United States. We talk about it quite a bit. The data centers, the semiconductor fabs, the nuclear renaissance. We've talked about critical minerals and metals, the reindustrialization of American manufacturing. There's a push going for all of it. But here's the thing. None of it happens without insurance. Not one factory can get built without insurance. Not one data center. No copper or silver mines. No nuclear reactors. None of these things happen without insurance standing behind it first. So insurance is the prerequisite. It's the layer underneath the capital layer. And almost nobody ever talks about it. And by the way, that's how we know America's rebuild is real. And, not just a bunch of headlines. The reinsurance giants, which are the companies that insure the insurance companies, they've started writing publicly about the data center boom. And the numbers really are staggering. Munich Re has described the market for data center specific coverage to be exploding from under $2 billion to roughly $28 billion by 2030, a couple of years from now. Swiss Re has been publishing research just this year, specifically on how hard it is, though, to insure these next generation AI facilities. And that's exactly because they're so new that nobody knows, what the big risks are. Nobody has data on what could potentially go wrong. And that little breadcrumb there, or I guess that last point is a breadcrumb, and it has investment implications for us if we pay attention to it. When a risk is brand new, maybe it's a first of its kind AI data center, maybe it's a highly automated semiconductor fab, maybe it's a small modular nuclear reactor campus or a critical minerals processing plant here in the US, whatever it is, if there's not decades worth of data on the actual operations, the big standardized insurance carriers, they're not going to touch the project. They need actuarial history to insure something, and there just isn't any history yet for these newer ventures. So that novel, hard to price risk, it gets shunted into a specialized corner of the industry that's called excess and surplus lines, or E&S. And the E&S market, it exists entirely to underwrite those risks that the other insurance companies don't want to touch. Okay, so the American E&S market has been booming for a couple years now. It's been growing far faster than the broader insurance industry. The standard explanation that you might see, if anybody even bothers to talk about it at all, is that this just reflects what they call a hard market, which means regular insurance companies, the standard companies, are pulling back. They're not underwriting as much as they have been, and that is pushing prices up. And that's certainly part of it. But I would suggest to you that there's a deeper current running underneath. The E&S market is growing because America is trying to build things that it has never built before, and it's doing so at a scale that it has not attempted in generations. So every new project throws off genuinely new risk. And that risk, it's got to land somewhere, right? And it lands in the E&S segment of the insurance industry. So I know that's getting a little long-winded, but the point is this. If we believe that America is entering a real physical rebuild, and if we believe that the reshoring and the reindustrialization push is real, and the data thus far suggests that they are, then it stands to reason that the insurance capacity to underwrite all that economic activity, it has to expand right along with it. All that's to say, I think the insurance market is something to watch very closely in the months and the years ahead. The industry data is going to likely tell us the story of what's really happening on the ground long before the financial media ever catches on. What's more, the top tier E&S insurance companies look like great investments to me, given the current backdrop. And when we invest in a world-class insurance company, we're not just buying the stock, right? We are taking partial ownership in the company. And that means we are fundamentally investing in the insurance business and all the investments that it makes as well. And I think that's how we should look at it, right? That's how we should think about it. So friends, I think we are entering into a fascinating period in American history here. We're going to go through a massive economic reorganization. In fact, we're going through it right now. Of course, the media they're going to spin everything as political, and they're going to try to get people to argue and fight with each other. They're going to sensationalize everything to push their own biases. Guys, we just got to tune that junk out. Because if we do, we'll see that what's going on is genuinely interesting. This is a major shift, and it's not going to move in a straight line. But as with any other major shift, there are great investment opportunities in there for those who can tune out the noise and focus on what's real. We've talked about how real assets are reasserting themselves right now. I would suggest to you today that the world-class insurance companies can be a cornerstone of a bulletproof portfolio as well. And so these are all things that we cover extensively at the Phoenician League. If you aren't already, I'd invite you to get on our email list to stay plugged in. And with that, I'll leave it there, and I'll see you again next week. That's going to do it for today's episode of the Phoenician League. If you found any value in today's conversation, please subscribe to stay plugged into the network. We put out new episodes every week. And if something we talked about today made you think differently about money or investing, please leave a review and let us know. That helps the show reach the people who could really benefit from it. And remember, financial freedom does not start with money. It starts with understanding and a fiercely independent mindset. So if you would like to dive deeper into the topics we cover, I invite you to get on the Phoenician League email distribution list at PhoenicianLeague.com. We often send out detailed written analysis on the various investment opportunities in the asset classes that we advocate, and we connect the dots across what's actually happening in the global economy. And then we host online strategy sessions periodically as well, where we can really drill into how to take full command of your financial future. So stay connected at PhoenicianLeague.com. And until next time, let's stay smart and let's stay independent. This is Joe Withrow, signing out.